Hi, this is Aaron Fernstrom, Director of the Mayo Center for Asset Management at the Darden School of Business. We're here with Sarah Marie Martin at the 2020 Academic and Practitioner Symposium on Mutual Funds and ETFs. Sarah Marie, thank you for being with us.
Thank you for having me. Great to be here.
Fabulous panel.
Thank you.
And so I thought maybe where we could start is just giving us kind of a high-level understanding of, what your day-to-day looks like.
So I am a financial sponsors coverage banker. I work at Goldman Sachs. My day-to-day consists of throwing 1,000 balls in the air and trying to catch 900 of them, sometimes successfully, sometimes not. My clients, generally speaking, are large private equity firms like Carlyle and Apollo. I cover some sovereign wealth funds like GIC. I'm involved in covering the private equity side of BlackRock. So it is not only private equity firms, it's private capital broadly defined, which in our parlance includes sovereign wealth funds, pension funds, infrastructure funds, energy funds, large family offices. Basically anyone who has a pool of capital and a staff that can move quickly to participate in one of our sell side processes. So my job is to work with those clients, help them buy companies, help them finance the companies they buy, help them build those businesses over time, which may involve M&A, it might involve some debt financing. And then when it's time to sell those businesses, I will help them either sell the business, IPO the business, or a few other kind of strategies in between. Maybe we look at both. That's where I spend the majority of my time. What I also do, because some of our clients have become so large and are quite institutionalized, we refer to them as the alternative asset managers. So firms, generally speaking, that are public, Carlyle, Apollo, Blackstone, et cetera, we cover them very much like large corporate clients because they are large and complicated. They're in multiple business lines, and that relationship is much more of a CEO, CFO, senior management relationship, thinking about strategy and M&A, perhaps financing for the GP, for the top of the house, for the business overall.
Sure. That's so interesting that you cover both asset owners and asset managers. Do you see, are there any trends or differences in kind of how they review opportunities or interact with you folks, or how you interact with them depending on kind of which camp they fall in? Or, is everybody very similar? Are there big differences?
I would say there are a lot of differences, and probably like any company, it comes down to the individuals that you're interacting with. I guess I would say one of my favorite types of clients to cover would be funds that are successful and growing, but tend to have a focus. So one example in my world is Clayton, Dubilier and Rice. And they're an extremely successful, very well-established firm. They've actually just recently, like many private equity firms, gone through a generational transition and a management transition quite smoothly. But what I like about covering them is they know exactly what they do. They have a strategy. They're one firm. They're U.S. and EMEA focused. They know what industries they invest in. Their strategy involves having a suite of the most incredible operating executives in the world, a lot of whom started with Jack Welch, sourced from GE and other incredible places, but find businesses that they can, in the industries that they cover, in the geographies that they care about, that they can operate better.
It makes sense. And I mean, are we like when there's a transaction, is it equity, is it debt, is it a blend of both? I mean, you hear so much about this like explosion of private credit. Does that work its way into your work or something? Yes.
All of the above. Our business is, as we talked about in the panel, our business is changing so dramatically given the proliferation of capital, equity, and debt. And for someone like me who's been a banker for 25 years and focused on private equity firms and private capital for the last 15, it's an exciting time to be there because our industry is growing. Our percentage of revenues to Goldman as an investment bank are growing, and there's just a lot of exciting change that we can be a part of. So yes to equity, and what I would say on the debt side is, I read that in the last few years, the size of the private debt market has grown 350%.
Right.
That's a PitchBook stat. And the reason for that is partially the banks, such as where I work, are being disintermediated by really aggressive private capital sources. And part of that is that we have some regulations, we call them SNC, Fed, and OCC regulations that these other private lenders are not subject to. Right. So they can be very competitive in the middle market. Generally speaking, their companies also go to the rating agencies. So there's some structural reasons why this particular where these particular providers of debt can be very attractive. I would say I benefit from working at Goldman because whereas we can do regular way debt financing in the leveraged finance markets or certainly investment grade markets, but that's not the world that I live in, we also have very large private debt funds, mezz, and loan funds that we can offer our clients a menu of alternatives and therefore partake in any and all of the activities. But it is a very dynamic time in the world of private debt for sure.
Do you see bubbles forming, I wonder, either in private equity or private debt, just, being so active at such an important intersection of these capital markets?
It's a very good question. It was a hotly debated topic on the panel. I think maybe the best answer that was given, which was not my own, was there's a bubble in everything right now, and all assets are expensive. And my reaction to is there a bubble in private equity was no. I don't think there's a bubble in private equity. I do think prices are expensive. The average LBO last year went for 11 times. And with the giant equity check as well associated. It wasn't all debt funded. It was, probably 5 to 6 times debt funded. So assets are expensive. On the other hand, assets are expensive in the public markets, and assets are expensive in all markets. So, and interest rates are very low. So I think you could argue if you did a fundamental valuation analysis that the prices people are paying are fair. And generally what we're seeing is our clients are garnering the returns as they exit their investments that they would typically expect, which would be like a 15 to 20% gross IRR. We're also seeing our clients act very carefully. We're seeing them stand aside when they think things are getting too frothy. It is a very competitive environment for our clients as well. So I am not sensing a bubble, but I also agree with our panelists who said there may be a valuation bubble in everything right now. I certainly hope. There's always concerns, but I guess right now I'm saying no. There's no bubble.
Sarah Marie Martin, thank you so much for
Thank you for
joining
having
us.
me.
It's great to be with you.